monetary policy, which is often used to combat inflation. And I'm going to look at the cases in the United States of America as always. So let's start with keywords, okay? What is contractionary monetary policy? It's the use of monetary policy tools to limit the money supply, to raise interest rates, and encourage leveling off or reduction in economic activity and an inflationary tendency. So, to put it more simply, this is often implemented to reduce the inflation. When inflation is too high, they want to make sure it's not it's gonna go down, or they want to when they think that it's gonna go up, the inflation will be too high soon. They can also take this approach to prevent that in advance. And we all know that 2% inflation is good, but anything above that, especially if it goes all the way up to like 5%, 6%, or 10%, or 20%, it is catastrophic for the economy, especially in terms of the saving that you have. The value of the saving, the real value of the saving, will be eroded quite significantly. You don't want that. It's really disruptive. They want to prevent that. Or combat that by taking this approach, which is contractionary monetary policy. And who does it? It's not the government technically. It's central bank. You could argue it's part of the government, but it's technically independent from, for example, president, prime minister, Congress. They make an independent decision to combat inflation. I'm gonna go back to these words later. So let's start answering this very important question, okay? Why does contractionary monetary policy combat inflation in the first place? So inflation is caused by shortage. We all know that, whether if it's driven by demand, surge in aggregate demand, or decline in aggregate supply, such as oil shock or this catastrophic wars on the soil of your country, that can reduce the productive capacity, right? Either of this or both of these can lead to shortage, which drive up the inflation in the market in macro scale. So, knowing that's the reason, by implementing contractionary monetary policy, which raise interest rates, we can disincentivize investment and some consumer spending too. Remember, investment is the purchase of structures, equipments, or inventories by firms, right? If it becomes, and a lot of these firms do this, purchase those things by borrowing money. Okay, a lot of firms, they're active borrowers. Consumers also borrow. For example, they borrow money from banks to buy car, by taking out car loans, or education too. When you go to university, you take out some loan from the banks. Those are the example of consumer spending that is based on borrowing. But a lot of firms do use borrowing to make a lot of investment, and that can cool down with higher interest rate because it becomes expensive for them to buy, right? So that lead to aggregate demand going down, less aggregate demand, which mitigate inflation. Let me draw that very quickly. I don't need to spend too much time because I'm sure a lot of people already know this. We use ASAD model. We have AS here, aggregate supply, which represent the productive capacity in a given price level. And we have real GDP here. And then we have aggregate demand. Maybe aggregate demand surged too much, so inflation is now very high. The price is driven up due to the shortage. Then contractionary monetary policy can reduce the aggregate demand because it becomes expensive to spend, especially investment spending and some consumer spending too. Not necessarily government spending, but you could argue, well, the government could be really scared of borrowing when interest rate of the bond is higher than before, maybe. But I think those who are really sensitive about interest rate going up is probably firms and some households. Okay, and then let's answer the second question that is also very important. How does the central bank? Okay, how do the central banks raise interest rates in the economy? Like, how is it possible? Do they dictate interest rate? They don't fully dictate it. They don't fully control it, but they influence it. Okay, and what the specific interest rate that they influence is federal fund rate. Okay, what is federal fund rate? Let's go back to the definition part. So federal fund rate is the interest rate determined in the private market for overnight loans of reserves among banks. Okay, remember the bank has reserves. Bank reserve is like funds that is not lent out or invested by commercial bank, but kept as vault cash or in deposit at the Federal Reserve. So they're not lent to other people. They're just sitting there kind of at the at the reserve. So that is reserve, right? Well, they're kind of sitting at the account of central bank account, and well, retail banks are the one who controls it, own it, but they're not just using it. And there are some requirements. They have to. It's not like they actively want to just let it sit there. It is sometimes required. The portion. It is there's something called required reserve, meaning that they have to put certain amount of percentage of their reserve as well. They have to put certain level of money as required reserve, meaning that they in any circumstance they're not allowed to lend it to other people, whether if it's business, households, or other banks. Okay. And then we also have excess reserve, which is opposite of required reserve. It's the portion of bank reserve that banks are permitted to lend to their customer, but they're just there. It's not like they're obligated to let it sit, but they're just letting it sit. But at any point when they want to, they can take it out and lend it to other people, right? That is bank reserve. That is excess reserve, and bank reserve is those things. And okay, and then going back, federal fund rate is the interest rate of borrowing money among banks, right? Sometimes banks run out of excess reserve, which is problematic because maybe they have some opportunity that they want to lend to, but they don't, if they don't have excess reserve, meaning that all of their reserve that they have, or most of the reserve that they have, is required reserve. They can't move it, so they want to get more excess reserve. How do they do that? They can borrow from other banks. Okay, commercial bank can borrow from other banks. Of course, they're gonna pay interest rate. They're not gonna borrow for free. So that is federal fund rate. Okay, and if it becomes expensive due to the influence of central banks, they're gonna be really skeptical about borrowing money from other banks, which kind of reduce the availability of excess reserve, and that lead to high interest rate of anything, because now they don't want to borrow it to households, business, other banks, whatever, for business or purchase of cars, education, home, purchase of equipments, structures for any business ideas, whatever. They're gonna be really skeptical, which drives up the interest rate. So that's what happens when federal fund rates goes up. Remember, if federal fund rate goes up, other interest rate, whether if it's car loans or other loans, will also go up. Okay, always know that. And how do they do that? How do they influence the federal fund rate to go up? There are three methods that Fed or central banks in any country takes, and one of them is the most important one, in the sense that they use it very often. They're kind of like a main tool to influence the federal fund rate. That is open market operation, sales of or purchases of U.S. Treasury bonds by the Fed, or sales or purchases of any government bonds by the central bank of that country. Okay, central banks can sell their government bonds, reducing excess reserve. If central banks sell it, that means commercial banks pay for it. Well, they're making that decision too. They're never forced to buy it or anything, but Fed still sells it with a price that commercial bank is going to say, yes, we're going to buy it. So when that happens, excess reserve among those commercial banks will obviously decline, right? Because they use those excess reserve to pay for it. So that lead to less funds, and less funds means higher interest rate. Less loanable funds means higher interest rate. So that's what happens. Let me draw that very quickly. So open market operation is the name of such action, but when it comes to specifically for contractionary monetary policy, it should be open market sales. So this is loanable fund market. Sorry, okay, let's just say federal fund market. Overnight. Well, overnight means like once they borrow, they have to pay back the next day. That's how it usually works. Federal fund rate. And there's obviously supply and demand. It's gonna look like this. And then when the sales, open market sales happen, supply will decrease, shift to the left, because they're gonna have less reserve. Those reserves are taken by the central bank. They're not stealing it, but they're selling bonds, attractive bonds. So those, well, government bonds, attractive government bonds. So those commercial retail banks decide to yeah, hand out their excess reserve to get that, right? So, but that still reduce federal fund, and that lead to shortage and price going upward, which means interest rate goes up. In this case, it's specific interest rate for federal fund. So that's called federal fund rate. So federal fund rate goes up. Okay, that's how they do it. That's how they usually do it. But there are two other ways that they can do, in addition to the first one, open market sales. The other one is central banks can raise required reserve ratio, reducing excess reserve. Okay, so it's like a legal requirement. They have to keep certain amount of money as in bank reserve, and they are not allowed to lend it to any other people. If they raise it, that means that's going to leave less fund available for, well, less excessive reserve available for those commercial banks to lend it to businesses, households, or other banks, right? That reduces the federal fund rate too. Sorry, that increases the federal fund rate too, because they have excess reserve available, less excess reserve available to lend it to other banks who need that. So that increased the federal fund rate, which also increased the interest rate in the entire economy. And the last one is raise interest rate paid on reserves. Okay, know that when commercial banks put their money on bank reserve, they get some interest payment from Fed central banks. I heard they used to not do that, but now they do it. Okay, and they obviously the central bank has total control on how much interest rate they pay, right? So they can dictate that interest rate. They don't dictate federal fund rate. They don't dictate interest rate for other loans extended by commercial or retail banks or investment banks. But Fed has total control over how much interest rate they pay for the reserves. Okay, and they can raise it. If they raise it, what is it going to happen? It becomes more attractive for commercial banks to keep their reserves will keep their money in bank reserve because they can get quite a lot of payments. So any federal fund, well, if federal fund rate is below that, literally there's no incentive because they're gonna take risk and lend it to other banks. Then all that they can get is the principal plus some additional interest payment, which is less than what they could have got from Fed. So obviously they just choose to not lend it to other banks who need that, and rather just leave it in the bank reserve because it's just better, right? So therefore, raising interest. So therefore, federal fund rate can never go below interest rate paid on reserves. Okay, by Fed. So by increasing interest rate paid on reserves, federal fund rate also goes up. Okay, so same mechanism. I'm not going to redraw this, but supply just decrease for this, and that increased the interest rate in the entire economy, which cools down investment and consumption, as I already explained. Okay, so the last part is actual case studies in the U.S. Okay, there are three main ones that I'm going to explain. They're not exclusive, but they're really, really important and very good example. And the first one is amazing. Contractionary monetary policy was taken to address the very, very, very high inflation that was happening in the U.S. due to Iranian Revolution. Okay, let's actually look at inflation rate. So historically, sometimes it's extremely high, sometimes it's quite low, sometimes it's negative. And if you look at 1970s, throughout 1970s, they're suffering from very high inflation, well above the target rate of 2%. Look at this, it's like 12%. This is 12%. This is 8%, very high, right? And there's like a second wave of high inflation during 1970. It was mainly driven by Iranian Revolution, very high. And the central bank was concerned about it. They were like, okay, we have to cool down the economy. We have to drag down the inflation rate. We have to raise the interest rate. And did they do that? They did do that. A very clear evidence here. This is federal fund rate, which is not, again, dictated by the by Fed, but they are heavily influenced by central bank of the U.S., which is Fed. So in 1980, they drove up the interest rate. Okay. And then, was it successful? You could argue it was, because interest rate did go down all the way to 3.8%, 3.79%, 3.95% in 1984. Not necessarily very low, but it's significantly lower than what they were suffering from before. So you could argue that it was successful in cooling down investment and consumer spending, which reduced AD, aggregate demand, and inflation became much lower. Okay, it's like dramatic falling aggregate demand success. So it was somewhat successful. However, there was cost to it. Okay, whenever you reduce aggregate demand, or when you mitigate or limit aggregate demand, there are often, not always, but there are often very painful consequences, which is recession. Okay, so 1980 recession was largely caused by that spike in interest rate, which dramatically reduced investment. Okay, so GDP decline was 2.2%. Very painful recession. And the another evidence of this recession is unemployment, which was as high as 7.8% at its peak, very high. And the continued effort to raise the interest rate to combat inflation also led to another recession in 1981, and this lasted until 1982. It was the beginning of Reagan's administration. Very painful recession. GDP declined from peak to trough by 2.7%. Okay, very sharp recession, and the peak unemployment rate. Oh, I should add rate here. Rate exceeded 10% in the second recession. Very painful. So there is consequence, right? Maybe I should draw this one so it's people are gonna get very clear idea about how this happens. But we just need to go back to AS model, ADAS model, right? We have AS here, and we have AD here. We have price level here, and we have real GDP here. So yes, reducing AD could be a very good idea in terms of, well, let's just say it was initially here, right? If price level was here, but now it goes down to here. So inflation is less. Inflation is not as high as before, which is good. However, if you look at real output in the economy, it's much less because people are demanding less. Firms produce way less. That could shift the economy out of full employment level of output, so unemployment rate can be quite high, and that's what happened here. Okay, so it's not very easy. Okay, sometimes you really need to be careful in implementing contractionary monetary policy, because it could be successful in reducing inflation, but it's still a bad news if unemployment becomes very high as a result of that. Okay, another example is gradually rising inflation in late 1960s, which was also combated by contractionary monetary policy. Well, if you look at inflation rate, it is going up around the end of 1960, right? But it's less. It's more like a gradual one rather than like a spike. And you could argue that was caused by Great Society project, implemented by President Johnson, but also Vietnam War too. Government was spending quite a lot of money to make weapons and things like that they needed for Vietnam War. Very high aggregate demand for those two reasons, so inflation was rising. And then probably the central bank in the US was concerned about it, so they did raise the federal fund rate. They did they influenced federal fund rate to be higher than before, and we have a clear evidence of that here. Around the end of 1960, here, yeah, see, we see some spike in interest rate. So it's a contractionary monetary policy, and it did push down inflation successfully to a certain extent. Yeah, we see the evidence, right? It goes down to somewhere around 3%, which is way better than 6%. However, it also led to recession. I guess it was not as severe as this one, but it was still a recession, okay? Unemployment went up. And then we have another one, very good example, very recent example. Contractionary monetary policy was taken to address post-COVID inflation. Remember the COVID inflation, which was also really painful. Very high inflation that U.S. people didn't experience for a long time. This era, people didn't experience high inflation, but now, at this point, they did experience that. However, it went down all the way to somewhere around 3% after 2022. You could argue it was because of the contractionary monetary policy which was taken here. Interest rate goes up from somewhere around 0% all the way to 5%. Okay, so that's clearly an evidence of contractionary monetary policy. What's unique about this one is that this didn't push the economy into recession. Okay, aggregate demand probably slowed down or they declined a bit as a result of higher interest rate. It's harder to invest. However, that didn't necessarily led to decline in production in the entire economy, which would be characterized as recession, which often comes with high unemployment. That didn't happen. So you could argue that contractionary monetary policy doesn't always lead to recession. However, it often lead to we have a lot of examples in which it did result in recession. So it goes back to this discussion of like, should we combat high inflation even at the expense of recession and high unemployment? It's a very complicated topics because we all know inflation is painful, especially for savers, people who made efforts to accumulate their saving. They realize that those values are just eroding. That's really unfair. That's horrible. It's really disruptive for decision making and things like that. But unemployment being really high is also really tragic too. And we also have this interesting discussion of is contractionary monetary policy really effective in combating inflation? I think a lot of people, a lot of economists agree that it is. It is actually effective, okay? Because we have so many examples of inflation going down quite significantly, quite dramatically as a result of spike in interest rate, which has been implemented by the central bank. So you could argue it's really effective. You could argue otherwise when it comes to the discussion of expansionary monetary policy in increasing the actual economic activity. There are a lot of more interesting debates about it, but I think a lot of people agree due to various strong evidence that contractionary monetary policy always lead to mitigation of inflation. But as we know, sometimes that has some bad consequences. Okay, that's it for this video. Thank you so much.